Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Indian stock markets were spooked on Thursday by India's surgical attacks on terrorist camps across the line of control with Pakistan. The 30-share Sensex fell over 500 points during the day before closing 1.65% or 465 points down at 27,828, while the NSE's 50-share Nifty closed about 1.76% or 154 points down at 8,591. Now, this was the biggest slump since the Brexit decision in June. Now, history suggests that markets tend to react adversely in the beginning and then they recover as they regain confidence. So the question is, what's different this time around, if anything, and how should investors and policy makers view this current market uncertainty? To discuss this, I'm joined by Sudip Bandopadhyay, Group Chairman of Inditrade, and Chokkalingam, founder of Economics Research. Thank you both for joining me. So let me start with you, Sudip. So, and let me quote some stats from the previous time we had an altercation at the border. This is Kargil in 99. Sensex and Nifty declined by about 280 points and 79 points in 3 trading days initially, but recovered thereafter, ended higher by 652 points and 191 points when the conflict ended. 2 months' time in 99. Is there anything different that's this?
I think things are very, very different, Govind. I think, global markets are full of liquidity, and the liquidity is driving global markets and definitely India as well. Also remember, the macro and microeconomic factors in India have improved significantly from where we were when the Kargil conflict broke out. So fundamentally, Indian markets are in a much stronger position. Of course, when this kind of a geopolitical issue flares up, markets will be nervous and there will be a correction, and pretty much that's what we saw getting played out yesterday. I feel strongly that unless there is a full-scale conflict or something like that, markets will very quickly recover. Okay. Liquidity force is just too strong for market not to recover. Only one word of caution, because the valuations are full in a lot of cases. So the margin of error is very low. So the moment there is a flare up or the moment there is a negative news, markets will correct.
Right. So that's the trigger rather than anything else. And we will talk about the intrinsic strengths and weaknesses in this market so as to understand it better and its response capability. Chokka, what's your sense if you were to compare with the past, and should the past be any indicator of the present or immediate future?
Very interesting question. I always keep saying that history is only source of learning. It doesn't become a rule, at least in the stock market.
Okay.
And point two, I wish what happened in Kargil war gets repeated as a fund manager, but I have a different view for 3 reasons. At the time of Kargil war, the entire market cap of BSE was hardly around 6 lakh crore. Today it is 110 lakh crore. The market structure itself has changed, size and structure. Structural changes are also there because FIs were not dominant at that time. Today they are predominant. And F&O size was not dominant. Today it can dictate even the cash market. Lastly, in the last 1 year, the small and mid-cap stocks, the combined market cap has gone up by over 50%. So we are sitting in a bubble in 2/3 of the mid-cap stocks.
Okay.
So therefore,
and that's the segment which also fell sharply on Thursday.
Yeah. Therefore, if there is any renewed tension on the border, I would be a little worried. So I would advise caution rather than being optimistic on the basis of history.
Right. So if you were to look at a layer further, what could be the real impact of this? Suppose, let's say there is some escalation, God forbid. Suppose there is increased cost in the economy. What could this mean from a market's point of view?
Well, I think if there is an escalation and the economy suffers because of that escalation, of course the market will take a negative view and there will be corrections. Govind, as I mentioned, the valuations are pretty steep. It's not cheap, let's put it this way. So the margin of error is very low, so there will be correction. But having said that, fundamentally we are at a very good place today. And I don't see a major correction. If you're talking about a levels which is 10% lower than this, I don't think that's going to happen.
Right.
But yes, the correction we saw yesterday is similar or part of that kind of correction.
Right.
We may see again if there is a flare up.
Right. So if I were to put it this way, is a 1.65% correction mild compared to what it could be, let's say, if things were different?
Yeah, if there is a significant flare up, even from here on, the correction can be even as much as 5%.
Okay. But at this point, I mean, if I were to just judge the initial reaction, it doesn't seem to be all
not
that much.
Not at all.
1.65% is mild.
Yeah, absolutely.
Right. Okay. So let's try and understand on a more broader basis strengths and weaknesses in the market going forward. So one is, of course, as Sudip said, it's valuations. What else?
No, I mean,
valuation is a weakness, I'm assuming
it's
now.
a big weakness, particularly for the small and mid cap. And secondly, there's a lot of stocks which are driven by perception rather than by fundamentals. So they don't have a valuation at all. So these are the two big risk factors. And third, I don't want to visualize a situation of full-fledged conflict because stock market is a place where it's going to be disastrous if there is a full-fledged.
Yeah, to the extent that it will be a reflection of the economy itself and what damage the economy.
What happens in a war situation like, the perception plays a more role than the actual damage to the economy.
Right.
So it is very difficult to visualize a kind of impact it will have on the market. It will be very bad. It will be very bad. So I wish it doesn't happen.
Okay, so that's going forward. So if we were to sort of segregate the strengths and weaknesses at this point, Sudip.
So I think, look, as we keep seeing that liquidity is what drives the market in the short term, and that's pretty strong. Look, the global markets, the return they expect in the global markets is much lower compared to what they can get in India. Even on a fully hedged basis on a GSEC, people are making money if they are bringing money from these developed markets. So that arbitrage, that trade is playing out, and that will continue to play out for quite some time. Also, even if you see when this government came to power in 2014, and index went to 9,100, Nifty went to 9,100, the fundamentals then and the fundamentals today are significantly different. Whether it's the macro numbers, whether it's the company fundamentals, everything has improved significantly. So we are on a stronger wicket, much stronger wicket compared to what we were earlier. So I think things are much better. But as Chokka mentioned, if there is a full-fledged conflict, of course, I mean, God forbid that happens. Right. I think we have it.
Right. So let's go back to the strength. So you're saying economic strength, of course, because as you say, between even 2014 and today, things are much different macro indicators. Second is corporate balance sheets are much stronger, and we've seen strong single-digit growth in the last 2 years. Are there any other strengths that we should be placing on the table? As
I think, as I said, Govind, the global liquidity. I think that's significant. Significant. Yes, quantitative easing and loose monetary policy was even there in 2014. But between 2014 and 16 and where we are sitting now, significant amount of liquidity has been pumped in the global markets, and that is floating around.
Right. So let me flip that question and put that to Chokka. So if we were to look at weaknesses, the fact that we are dependent on global liquidity, as we've been in the past, is that a weakness at this point of time?
Certainly, because they have a lot of options if there is any conflict. And very interestingly, I completely agree with Mr. Sudip on the stronger point. Economy is in a much better position. In fact, things are turning around.
Yeah.
But it's only the perception which can make a devastating damage to the market in the event of full-fledged conflict. Okay. There is another very weak point. Apart from global liquidity, as per the latest RBI study, what has happened, the households, they have reduced the share of bank deposits and increased significantly the share of money invested in shares. So therefore,
but I thought it's a good thing, because considering our proportion is
good
so
and
low.
It is nothing. It has to improve a lot.
Okay.
But in the short term, if there is any fear factor, then the middle class households, they can again do reverse in the short term. So that could be another risk factor for the market.
Okay. But if you were to now look at, let's say, a few months ahead, what would be your outlook? Would you think that middle class investors, as you said, who are now increasingly putting their money in stock, should be thinking otherwise?
No, a few months down the line, I'm very optimistic, because the kind of conflict and all you saw yesterday, each stock in a mid-cap segment falling 10 to 20%. So things would be discounted in a matter of few days or few weeks. So few months down the line, again, market will bounce back in a big way, but we don't know from what bottom.
Right. Okay, Sudip, so should there be any policy intervention? Sometimes when markets fall, the Ministry of Finance comes out, makes a statement. Obviously, this is not the same situation. Markets haven't fallen because of external factors. It's because of something that we've done. So would you expect any intervention?
Well, I don't think there will be any direct intervention. If the conflict continues or some escalation happens, I think then there has to be some intervention from the government to soothe the sentiments of the global investors more than anybody else. Domestic investors, I think his point is absolutely right. But I think today,
confidence levels have been rising.
Today, the global investors need to remain confident on India, and that's very critical. We have worked hard to create this confidence in India, and I don't think we should lose that in such a small conflict or such small trivial issue. Now the question remains that shall we also expect an interest rate cut? My view is we should, because as a central bank, they should look forward. If today we are, all of us are sure that we had a good monsoon, crop arrivals are going to be significant, agricultural inflation is going to come down, then RBI probably should take action now. And the current policy, the first time the monetary policy committee will meet, I'm expecting some kind of interest rate action. Actually, there's some cut expected.
So that's the internal part. But on the external front, we should be sending a clear signal out saying that, business is going on as usual. This was obviously a localized event, and investors should feel free to continue to invest.
Absolutely.
The most powerful intervention would be ultimately, which will be inevitable if there is a further conflict, is buying of shares by the government-owned institutions. That is the only factor which can provide some support.
Yeah, but that's only if things were to get worse, but which may not be required considering that we're already talking about a high level of liquidity.
That's right.
Anything else from the policy side?
Well, not really. I think the government has to do the damage control in terms of the sentiment. Pretty much that's what it is. No fundamentals have changed or are expected to change if this kind of small things happen. But they have to do the psychological and the perception control, damage control on that.
Okay, Chokka.
I mean, you have to. As of being a patriotic citizen, you can't give importance to market. You have to give importance to security.
Right.
So therefore, I am not in a position to defend the market. You have to face it, whatever pain comes as a patriotic Indian. So therefore, what I feel the government has done is the right thing.
Right.
So you have to face it and pay the price in the stock market.
Right. Okay. So if I were to, assuming let's say something like this had not happened, just let me revisit the points that you had made. You said that in 3 months, in any case, you were positive because all the other factors are strong. We're likely to see a bit more magnified impact of better monsoon, 7th pay commission, and so on. Are we on the same page here?
Certainly. As he also mentioned, apart from that, excise duty collections, fuel consumption, import of crude oil.
This is just to give comfort to people who are watching. I'm saying, okay, what are the things that are really going in our favor? Everything
is in favor except the degrowth in the exports.
Okay.
All macroeconomic factors, all of us know the external factors like a CAD, the forex reserves, external debt, even the composition of external debt in terms of short-term debt and the total debt, everything is comfortable.
Right.
But this is the only fear factor which is...
Last word, Sudip.
I completely agree with him. And, I think the biggest thing is the global liquidity. I'll still put to that, which has nothing to do with India. It's just that the global central banks are pumping more and more liquidity, and I don't see that not being there till at least December. Only after the US presidential election is over, the new government is in place, they will probably rethink on the liquidity and measures. So till December, I think we have a clear runaway.
Right, and we need to send out a quick message to investors and others outside that business continues as usual, which of course it does.
Yeah.
Thank you both for joining me. We need to go in for a break. Coming up on the other side, a monetary policy committee is set to meet and take a decision on interest rates. How will it do so? Stay with us. Welcome back. Interest rate setting by the Reserve Bank of India will not be the same again. The government has notified a 6-member monetary policy committee which will decide interest rates from the October 4th policy meeting. Now, 3 members in the MPC are from the Reserve Bank, including the Governor Urjit Patel, while 3 members are from outside, appointed by the central government. Now, the government has said that a committee-based approach to determining monetary policy will add a lot of value and transparency to monetary decisions. How indeed will this new approach work here on, and will it change the way decisions have been taken in the past? And indeed, could there be a different approach to interest rate setting? To discuss this, I am joined by Saugata Bhattacharya, Chief Economist at Axis Bank, and Anjali Verma, Economist at Phillip Capital. Thank you both for joining me. So let me get your first thoughts in, Saugata. So the new monetary policy committee, fundamentally a different approach. Now one person's diktat or one man's diktat as the case was. So how is it going to change?
I think the first thing that will come in is more transparency, as you mentioned, that the mandate of the Monetary Policy Committee, unlike the Technical Advisory Committee that now has a recommendatory role. So each member will vote separately, that vote will be made public, and the reasons for the vote is also supposed to be made public, which is quite a move forward in terms of transparency. So it's a multiplicity of rationales, reasoning for the decision to cut, hold, hike, whatever. I think that will now be in the public domain. So that will give you a much broader range, a picture of the various considerations that go into the policy decision.
Right. But does this committee, for instance, what if the votes are tied?
Then the governor has a casting vote.
Right.
So, I mean, if 3 and 3, 3 no, 3 yes, then the governor has a casting vote which tips the decision one way or the other.
Right. Okay. So, when you say transparency, how does it help the collective knowledge or public decision-making process? I mean, if you know that, okay, here is what each of those 6 people thought and this is what their approach was.
Well, I mean, something like any decision, just like used to happen with the electricity regulator or the other regulators, and even SEBI, say for instance, any decision that has a set of has thinking, the embedded thinking out in the public. Of course, the monetary policy statement does give you an idea, but the monetary policy statement is one aspect of this thing.
Yeah.
So, I mean, the post facto TAC minutes, the technical advisory committee meetings were also available in the domain, but you didn't really know who and what was thinking about this. Now that we know who the members of the monetary policy committee is and what their basic
their qualifications, their background,
their
economists,
analytical backgrounds, etc. So that will bring in multiple domains. I mean, say for instance, one of the members of the MPC has a strong background on non-financial matters. So in terms of other developmental orientation to the monetary policy outcome will now be available for the public.
Right, and we're going to talk about what's going to happen on the 4th of October. So, Anjali, how does this knowledge, or how will it potentially help your analysis of a way or a manner in which a interest rate decision was taken?
See, I think what it does is it provides a professional approach to the entire decision making and a responsible approach by all the members of the committee. So earlier there were, even earlier in the technical advisory committee, most of the members were highly professional as well as hardcore economists. Same continues to be the case right now, but their approach, individual vote that they will be casting will be more, responsible, and they will be confident that it will make a difference, right? Because, so that is one. And overall, all the members that have been selected seem like, hardcore professionals.
Yeah.
And therefore, the decision making will be, more focused and more fundamentally sound.
Right, no, that's fine. So my question is, how will your understanding as an economist improve or change?
See, I think we'll see the first monetary policy which is going to happen now as to how things are really changing. But all in all, I think the macro factors will almost be the same. So inflation, fiscal deficit, growth. I don't see, in terms of our understanding of the monetary policy decision making will be much different after the monetary policy committee is in place.
Saugata, what's your sense? I mean, will it improve? And therefore, if it improves your understanding, then arguably all of us will also get a better understanding.
Certainly, because I mean, even now, as I said, the monetary policy statement does lay out the underlying assumptions behind the policy, the targets, the forecasts, etc., that are laid out. But what this serves to do, from our perspective, not from the MPC perspective, from our perspective, is give individual rationales for the diversity of views, which we used to get in the TSE minutes, but we couldn't ascribe it to certain persons.
Right.
So I mean, so this is the individual views which we can use to question our own assumptions, the assumptions that we as economists make. I mean, so that this is more useful. From the MPC part, what Anjali was saying, that this introduces more accountability into the monetary policy making. Previously, we didn't. The accountability used to be centered on the governor. So now it's a more diffused accountability and a diffusion together with multiple decision making points. I think arguably makes for better policy.
Right. So a more straight question now: could the decision be different? Could there be different decisions now that it's a committee and you have the wisdom of a group?
Most certainly. I mean, this is what opens up the possibility of further clarity and transparency in the debate. Because till now, we had an idea from the TSE minutes, the recommendations of which way people were moving. I mean, were the bulk of the people in favor of a cut or more liquidity or whatever. Now you know exactly who is in favor of what.
Okay, so let me put the question differently and maybe a little more mischievously. A lot of people obviously are clamoring for a cut. So does the existence of a committee increase that possibility?
No, I don't think so, because remember, I mean, this is not just the
because there's a group.
I know this is not just from the banker's perspective or the government perspective or the policymaker's perspective. The credibility of monetary policy is something which is very, very critical for macroeconomic stability. If investors believe, if decision makers believe that a monetary policy making is credible, I mean, that puts that economy, which is exactly what happened over the last 3 years. I think this is what makes the monetary policy decision making so so, I mean, if not rigid, so such a responsible exercise that the members would need to be accountable for the decisions that they are making, and this is a very important.
So, and could it be the flip then? Maybe the willingness to take a decision may be limited then. What do you think, Anjali?
I don't think so. I think all in all, every member knows, I mean, what are they here for? They will do proper analysis, as has been the case earlier. So I am not of the opinion that decision making under MPC framework will be substantially different than what was happening under the technical advisory committee. Yes, we'll know which member is thinking how and what decision was made, and we'll know if they are dovish, hawkish, and all in all how the entire committee, how each and every member of the committee is thinking. So that bit of transparency is there, but I don't think decision making will be a lot different or can be influenced more.
But could they be seen to be wanting to be playing to the gallery?
Not at all, I don't think so. Especially looking at the profile of the members who've been selected. Even if you look at the government nominees, they are hardcore professionals, economists.
And that's a list that the Reserve Bank itself has sent, and that's how they've been selected.
Playing to the gallery, meaning what part of the gallery?
The gallery that wants lower interest rates. I mean, that's really the gallery.
That's a decision. That's a decision. That, I mean, I believe that a lower interest rate.
And what's wrong in that? If it is.
So which brings us to the question of the day, right? So October 4th, what's your sense? I mean, we seem to be arriving at a presiding consensus that interest rates are headed low.
I think so. Interest rates are anyway headed lower because of the liquidity infusion that's coming in. I think the financial and economic conditions at this point in time, I think, are consistent with a rate cut view. So, of course, there are risks. What happens to the US elections, the FCNR redemption process. But I think the balance of probability, I think, is for macroeconomic conditions to remain stable enough for them to want to lower interest rates.
But only a few weeks ago, Anjali, we were talking about concerns from a high inflation rate environment. So where are we on that?
So the last 2 month inflation data has been very impressive, particularly because of food inflation. So that has fallen substantially. And similarly, fuel has been sort of supportive. Of course, OPEC has taken a decision which there are concerns in terms of risk on the upside for the fuel prices. But all in all, assuming that commodity prices are stable and monsoon has been pretty good, inflation should be within RBI's comfortable zone of 5%. Now, whatever we know, how decision making was being done under Dr. Rajan's governorship, if that continues, then that warrants a rate cut and easy monetary policy. If something changes under the regime of new governor or the monetary policy framework, then we'll have to take a new opinion altogether. But at the moment, it looks like there should be a rate
you're saying that we have the necessary preconditions and the required preconditions for a rate cut? Would that be a fair?
That's the inflation growth trade-off, as they normally say. Right now, I think favors a rate cut. According to their own rule, I mean, remember the governor saying that the 1 year ahead T-bill rate should be about 150 to 200 basis points, 1.5 to 2 percentage points above the real rate, above inflation. So at this point, I mean, with the repo rate at about 6.5 and the inflation about 5, which, as Anjali was mentioning, even going forward, I think that can easily give them room to cut by 25 or 50 basis points. I don't think they will cut 50 all at one go.
I think the expectation seems to be 25 basis points on October 4th. So what could that do, and where will it help? I mean, obviously, apart from the retail impact, which could, if the transmission happens in the right way, could help, let's say, borrowers and so on.
I think that's the first point. I think because at this point, with the oncoming festival season, a rate cut now with liquidity allowing banks to pass on the rates, which I'm sure banks will do at this point in time, pass on rate cuts will fuel a little bit of retail consumption demand. Maybe a little bit of home loans as well, although home loans are anyway growing quite rapidly. So from this consumer perspective, that will be the first impact. As the consumption increases, as capacities begin to stretch and tighten, that's when the next phase of the capex cycle will come in. And together with the liquidity which the Reserve Bank is anyway promised to provide, I think that will begin to lower wholesale rates.
Right. So the other question, let me come to you, Anjali. So we saw these surgical strikes across the line of control, and that in some ways was imminent because there were so many problems there. So the markets have taken a bit of a hit, but it seems like it's temporary. So has the rupee. Now, what's your sense? I mean, does this call for some kind of policy response in terms of soothing markets, currencies, and so on?
No, not at all. I think it's currency on its own is quite stable, and it was strengthening, substantially until this happened. Around a level of 67 is fairly good, and even when it was strengthening, we were expecting some response from the RBI to prevent substantial strengthening. So FC and RB outflow impact we'll have to see, but I don't think it's going to dent currency in either way.
Right.
So it's more or less it's going to be a stable zone.
Right. So Saugata, last word. I mean, if you were to add this element to the other factors that we've talked about, could that influence rates, and also is there anything else that we should be looking at?
It always, geostrategic aspects always influence policy decision making. But I don't think whether a rate cut or not, because there are too many factors involved. This is
Some other policy intervention.
Definitely. I mean, if markets begin to tank or something, so that will, if because of a threat of forthcoming war or something, then there are other measures that need to be put in place to soothe investors. But I don't think monetary policy is the appropriate tool for a geostrategic aspect. I don't think.
And you're saying otherwise, if you look at the reactions of Thursday, things seem to be more or less under control.
I think so. I mean, you've already seen the rupee retrace downwards. That is to say, already appreciated from last levels.
Right.
And I think
the markets are also stable at this point of time.
That's right. Absolutely.
Right. So all in all, a good note to look forward to a rate cut. That's, I think, a good note to end on as well.
We hope so. We hope so. We hope for a rate cut.
Right.
Yes.
Thank you so much. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.